Hey everyone, welcome to the Level Up podcast, presented by the Medici Network, the exclusive community for financial institutions to engage with blockchain-native funds and founders. I'm your host, David Breiter.
And I'm your host, Sean Farrell. Before we kick things off, make sure to hit the subscribe button and follow us on Twitter for the latest episodes.
This podcast is for informational purposes only, and nothing herein should be considered financial, legal, tax, or investment advice. The views expressed by our hosts and guests are their own and do not reflect those of the Medici Network, Fundstrat Global Advisors LLC, Finality CP Management LLC, or their respective affiliates. All listeners should consult their own professional advisors as to the legal, tax, financial, or other matters before making any investment decision.
Now, let's get into it. All right, everyone, welcome to Level Up. I'm David Breiter, and I'm back here with Sean Farrell. And you all might remember we did a great Medici interview at the Medici LA, and we are here today in Singapore, across the world, and we're doing Medici Singapore. We've got a great lineup today of people coming through for interviews. Medici is obviously a very special place. We're gonna look forward to having a lot of great people on the show.
All right, let's get into it.
Let's get into it.
Well, now we are delighted to speak with Rebecca Wu, Managing Director at Farro Capital and allocator in the space. Rebecca, welcome.
Thank you.
I hope you've been having a great time at Medici Singapore.
Absolutely.
So I guess maybe we start out by maybe chatting about Farro Capital and what you guys invest in and your approach to portfolio composition.
Okay, thank you. So Farro Capital is a multi-billion-dollar multi-family office headquartered in Singapore with offices in Dubai and as well now in India. I'm a senior investment professional there. I've been investing for 20 over years, so don't guess my age. But I'm essentially a global multi-asset allocator. So at Farro, we advocate building long-term resilient portfolios, institutional quality, endowment style. So we really, work with our families closely to strategic asset allocate across markets, asset classes, and strategies.
I have to ask, you do a lot beyond what we call digital assets.
Absolutely.
And I imagine within your universe, it's probably maybe a little weird to talk about digital assets. What is it like in your perspective coming to Medici versus other events? Do you go to other digital asset events, and how do you think about what you gain from this?
No, I think that's a great perspective, right? So I learned a new phrase this time that I'm known as someone coming from TradFi, which is traditional finance, right? So I was like, does that make me old? But I think the reality is there is a little bit of a dichotomy, right, between what we call traditional finance or institutional portfolios to what this new beast or this new thing called digital assets. I think in the good old days, it's called crypto, and then that caused a lot of heart flutters and panic attacks.
We don't use that word around.
Yeah, so now we don't. And the reality is, I think, as I shared also in an earlier panel at the Medici, is that we do advocate digital assets. We believe digital assets are here to stay in different forms and shape, and through different exchanges and different platforms and different geographies. So how we think about it is to think about allocating it as part of the strategic asset allocation. So maybe at this stage, or this early stage rather, it will not be a significant part of the allocation, but we will start, right? So I think as global multi-asset allocators, we look at public and private markets. We think of digital assets as cutting across both spectrums, so the public markets as well as the private markets. So we're seeing a lot of opportunities in the public side, which is the ETFs. On the private side, it really started with the venture asset class, right? But now we see, digital assets, hedge funds. We're seeing credit funds even, and we recently met a couple of distressed funds. So we think it's a very interesting and growing space, and we definitely want to be a part of it.
How do you think about, obviously allocators have different risk buckets.
Yep.
You just mentioned that you're starting to become more interested in hedge funds, liquid hedge funds, and crypto. How do you think about bucketing? Where do you place those within your different risk buckets? Because obviously they're operating in liquid markets, but perhaps might have venture style risk and returns.
I think, Sean, that's a great question as well. I think we really think of risk together with returns. We think of achieving risk-adjusted returns. So we don't look at risk on a standalone basis, and then we don't look at returns on a standalone basis. We believe it needs to be together, right? So, and for specific private markets, we think of the 6 what we call building blocks, right? So we have the hedge funds, the private credit, private equity, venture, real estate, infrastructure, and each asset class comes with its own risk and its own expected returns. So similarly, we'll apply the same logic to digital assets, right? So when somebody say, oh, this is very risky, what do you mean? Is it from a liquidity profile? Is it in the size of the opportunity? Is it the track record of the manager? So there are many layers to how you define risk, right? So I think the bottom line is we want to adopt what we call an institutional discipline when we evaluate investment opportunities, and we look at multi-factors and not just one factor.
Can I ask, thinking about constructing a portfolio with an allocation, you can tell us how you think it fits, but I'll walk through a few vectors, right? Obviously, some people think it's maybe 1%, maybe it's 2%. I've heard maybe some people say 5% allocation to crypto. And then, how do you think about that? And then two, once you get within that, how do you think about this allocation between right now, and then how's the mix change? Of course, public and private, passive,
active,
ETFs versus more active funds, and then maybe this is very granular, but within some of these strategies, how do you do that as an allocator and think about that?
I think that's a great question. So you're starting with the bigger picture, like you say, portfolio construction, right? So I think there is room for many of our families, not everyone, to have maybe 1 to 5%, like you said, in the digital asset space. And then when you break that down, would it be public or private, or we say liquid or semi-liquid or illiquids, right? So typically we like to start with the liquid space, really because it's easier to access. Usually the bar is lower, it's lower minimums. And for someone who's very new to space, you can come in and out if there is a change of heart or a change of mind, right? So the accessibility, the liquidity, it's helpful. So we always like to kind of start with that. And that's not just in digital assets. It's just kind of broadly for someone who is a new investor or a new family office, where do they start building their portfolios? And then when you go up the, what we call the more illiquid structures, right? Because once you're in a venture fund that's 10 years, you're technically locked in for 10 years, right? So are you prepared for that illiquidity? Can your family finances deal with that, right? The fact that you may not get any returns on DPI, you call it distribution, in year 7, right? So I think when we think of that portfolio construction, when you go down a little bit granularly, we do look at the liquidity profile quite seriously. So for us at Farro, we build bespoke portfolios. So we look at the situation of each family very differently, and your portfolio will look very different from his and mine, because we all have different needs. We're at different life cycles. We have different generation to take care of, and then so by putting that and having that building blocks in place is when we can then build what we call bespoke portfolios for each of the individual families, depending on their liquidity profile, depending on their risk appetite, and depending on their target returns. So it is going from the bigger picture down to what we call, like you said, the granularity of it, and then finding that eventual solution or portfolio that fits the particular end family.
Can I ask a follow-up?
Sure.
How do you think about, maybe on 2 vectors, how do you think about what's different between this asset class, whether it's venture versus digital asset venture versus traditional venture, right, digital asset hedge funds versus traditional hedge funds, on that vector, so that contrast? And then how do you think about the contrast within each bucket of identifying what makes a good manager or a good allocation?
I would say the biggest difference in this digital asset class or industry is that it is really still quite new. I started allocating to alternatives more than 15 years ago, and at that time it was called alternatives. But today, whatever I just described, private markets and funds, has become to me quite mainstream and to some extent quite commoditized, right? So the hedge funds are struggling to generate enough alpha. So what we call the traditional hedge funds, right? So we know majority of them actually don't generate alpha, and it's easier to get the same returns in the passive space and buy ETFs. So the entire traditional finance industry has also evolved a lot in 15 years. So I see the same evolution for digital assets, which means it is still a very new space. BTC, Ethereum, Solana, and then a lot of tokens. So there's just a lot of opportunities out there which are not what I consider at a stage of stability, right? We don't know where this coin's going to go, where this token's going to go. I think we're finally seeing some stability, at least with BTC and Ethereum, like they're kind of becoming the mainstream digital asset, if I can call that. So I think it's at this early stage where there is both significant opportunity to invest, to get returns, but also significant risk. So to answer that other part of the question is we employ the same discipline, even with traditional asset class, which means we want to do the same for our digital asset managers. We look at track record, we look at the team, look at what you're investing in, what is your logic, how you think about investing in this token or not this token or this company. So we don't think it needs to be any different just because the underlying assets are a bit different. That investment discipline and approach should still stay disciplined.
So you just mentioned that a lot of the traditional hedge fund space, I think, is, to crudely put it, expensive beta. Do you find that there is more significant as a overall percent of AUM alpha generation in crypto liquid hedge funds or no?
I'm not sure. So I don't have an answer to that because I think it remains to be seen. I do think a lot of investments in digital assets is also quite beta driven. It's very market driven. So in every market, it's always very hard to find the real alpha, right? In every asset class, right? How much of it is the rising tide, everyone just buying BTC and doing quite well? How much of that is really picking the good companies in this space? So we are always looking for that alpha. So like I said right at the beginning, I don't have an answer to your question because I'm just not sure that a lot of it is real alpha, real innovation versus a lot of hype and a lot of capital chasing a few assets.
Now, can I just dovetail on that a little bit?
Sure.
What is the right benchmark? Because I run a liquid fund, and I'll tell you, I don't know what my benchmark is, but I tell people my returns versus everything. I tell them what my returns are versus Bitcoin, versus ETH, versus Solana, versus the crypto 30. I tell them what they are versus the crypto hedge fund index. I tell them what they are versus the S&P, the NASDAQ, gold, treasuries. But I don't know what the real benchmark is. I don't think allocators know.
Yeah.
Because there's no S&P 500 for crypto.
Yeah.
Maybe it's just Bitcoin.
Yeah.
But sometimes, if it's ETH in 22, maybe it's ETH, right? And if it's Bitcoin's doing great, then it's Bitcoin, right? What is the benchmark and how do you establish that in your mind as an allocator?
I think you've answered it. I don't think there's an established benchmark now, right? I think at least not yet.
I agree.
For digital assets. So whatever you just described, I agree with you. I think because of that, we need to use a variety of benchmarks, right? Just to give us a sense of what is the performance of this investment or this manager versus what the broader market is doing, right? So we will use the same benchmarks for now, which is we'll look at BTC, we'll look at ETH, start to look at Solana. We'll, of course, compare to all traditional assets because at the end of the day, we're allocating across asset classes, right? So we need to, if we put 10 million into Bitcoin or digital assets, that 10 million could have gone into a very good hedge fund in a traditional, maybe global long-short equity, right? So I think as of now, it will be a variety of benchmarks until maybe one of the big investment consultants or one of the big groups, the ratings agency decide to come up with something that is much more, whether it's called institutionalized or much more mainstream. So I think agencies and groups, and I just now on the same panel, Cambridge Associates says they're beginning to work on it. So that's why I say digital assets is still at a very early stage of evolution. And in fact, if you think about private markets broadly, is there one private market benchmark? Actually, there really isn't either. I struggle with that. We've spoke to a lot of industry practitioners, Preqin, Cambridge Associates, and what have you. And they are also trying to, Thomson Reuters, they're all trying to come up with a credible, recognizable private markets benchmark. The same logic applies.
There's some B of A surveys recently. You obviously are very familiar with them on the public market side that they say, what is your allocation to crypto? I think structurally it was like 79, some very large percent had zero allocation because structurally they just couldn't buy. What do you think it is on like the family offices, the kind of private, institutional allocator side? What do you think the current allocation is and who do you think's on zero?
I think majority are still at zero really because of exactly what you said. The accessibility of digital assets remain much lower than your traditional equities, ETFs, right? Because you need that entire financial framework or platforms to be able to access. So of course now you have a lot of digital assets exchanges. But let's not forget that the FTX blew up was fairly recent, right? A lot of families were spooked by that and they're like, I'm going into an asset class that have massive counterparty risk. Can I trust this exchange, right? So you do need that reputable kind of establishment, kind of that mainstream establishments to encourage investors to be confident and comfortable that I'm investing in something that's not going to blow up in my face, right? So I think we're not quite there yet, but I'm beginning to see a lot of credible banks, even in Singapore, coming to this space, in the US, and enabling families or individuals to start investing in this space. So I think that statistics is actually quite accurate, and it's really because to some extent, like we said, the lack of easy access and trustworthy access. Yeah.
I think what Rebecca is trying to say is that we're still so early.
So early. But with early, there are a lot of opportunities, right?
That's right.
That's growth, right?
That's right.
So so I'm excited too. I want to be part of this journey. Yeah.
Amazing.
You certainly are.
Yeah.
Thank you for coming here. Thank you for coming on.
Thank you for this very interesting podcast discussion.
All
Yeah,
right.
thank you, Rebecca.
Thank you very much. All right, everyone. We're here at Medici again for Level Up, and we have Arthur from DeFiance Capital. Arthur, thanks for coming on.
Thanks for having me.
Absolutely. Arthur, tell the viewers a little bit about DeFiance, the fund, and kind of what you guys focus on.
Yeah, so I'm the CEO and CIO of DeFiance Capital. We are a crypto-native investment firm based in Asia across liquid and venture strategies. But right now, the flagship fund is a liquid hedge fund. Been investing in the crypto space since like 7 years ago. Main focus was DeFi. Ground zero participant of DeFi since 2019. Yeah, and always been believe that DeFi is the biggest product market fit of crypto. Yeah, this is where I'm passionate about.
Broad strokes, I'm curious. You've been in the DeFi vertical specifically for a while now. How have you seen the space, that vertical specifically, evolve over the past 8 years, give or take?
Yeah, so I think that we definitely have went past the 0 to 1 phase of DeFi. A lot of the ideas, experimentation have happened, and people kind of know what works and what doesn't work. I think right now is where DeFi really mature and tackle the distribution, trying to get into the 100 million user or even billion user phase right now. Yeah.
How do you think DeFi can tackle that distribution? Is that through centralized venues? What's the big?
No, I think the only thing we need is time. It's gonna happen. It's inevitable. Because I think that right now, the one biggest benefit is just DeFi is just so much more efficient. It improves the velocity of finance, commerce so much, and the efficiency improvement you bring is just going to outcompete all the other solutions out there given enough time. Yeah.
How do you think about your investment strategy? Is the majority, in DeFi buying tokens? Are you buying larger liquid stuff? Just what is your investment approach when you talk to investors?
It's a very classic fundamental discretionary long bias strategy. We try to find the best project to invest in at a fair valuations, and we try to go through with them through their growth phase. But we're not restricted to DeFi. We are pretty agnostic. It's just that currently we think DeFi is still one of the most exciting sector to be investing in. We look at AI. We obviously do the layer one, some of the infra stuff. I also like Pudgy Penguins. I think they're one of the best projects in the space. Luca is a phenomenal founder, and there's no cash flow. It's a pure brand IP play. But yeah, I'm very excited about Pudgy Penguins as well.
I'd like to unpack that a little bit. But do you think most of the investments you focus on are all on the crypto native side, or do you do anything on the other, like more traditional side as well?
Yeah, so I think there's certainly an evolution in this aspect. Earlier on the phase there's most of the exciting opportunities in the crypto, but I think this is the year of kind of like a watershed moment where we start seeing someone with a lot more traditional finance expertise gain an edge on the market. So we're all in the fund space, and this year the funds that crush, a lot of it really comes from the debts. The return from the debts, right? And the deal flow come where you have the traditional finance connection. Yeah, I think the crypto native only start catching on when we all see the returns of BMNR and Sharplink. Yeah,
yeah, it's kind of been a weird market, right? I think only a handful of altcoins are actually positive year to date, right?
Yep.
But with that in mind, what has DeFiance's attention? Any protocols, tokens that you guys are particularly interested in?
Yeah, I think DEXs, stablecoins are the two most exciting sector in DeFi right now, because those two sectors are the proven one to generate the most revenue, have the highest TAM and growth ceiling. Look at the leader of the respective field. Binance is probably worth between 100 to 150 billion on a very conservative basis. BNB alone is already worth more than 100 billion. And on the stablecoin side, Tether is rumored to be raising around at 500 billion valuation.
It's $500 billion.
Exactly, and that's probably put them as the top 3 most valuable private company in the world. So yeah, which is why I'm very excited about Ethena and also Hyperliquid, because these two protocols are the leader of the respective field. Obviously, we have Tether and Circle, but I think Ethena is the only one we see that are able to tackle all 3 core user segment that allows stablecoin to really grow to like a $1 trillion level. when you look at Tether, when you look at Circle, because I was very early user of both. In fact, I think at one point during a DeFi summer, we actually were the one that minting more USDC every single day. The compound looping, farming stuff, and Circle honestly got a lot of help from the DeFi community because they don't trust Tether enough, so they just all use Circle. But in Ethena, we look at it, they are able to tackle the distribution of both the DeFi degens, the on-chain guys, and this Chinese central exchange and the people in the suits with the launch of IUSD and all the institutional product they are launching. So I personally think that distribution means that they are able to capture all segments of different markets and give them the best chance of competing with the two behemoths of the stablecoin sector right now.
That's great. I had to ask, since you brought up Hyperliquid, how are you viewing, obviously there's a lot of buzz around the upcoming token unlocks, CZ launching his competitor. Yeah, what's broad strokes, what is your view on the current Hyperliquid FUD, for lack of a better word?
Yeah, so I think that people underestimate how long Hyperliquid have been building and the kind of loyal community they have been built up over the years. So that take 2 years, and Aster is a meteoric rise. But I think on a fundamental level, this is not affected yet. But that said, you shouldn't underrate the team's capability to build a very good perp DEX, because historically, Asian founders are pretty good at building exchanges. So that is something that we need to pay attention on. But I think right now, they're still pretty far away in terms of the product quality and everything, the community, all those things. So I think we need to see. But I think in the meantime, this headwind will exist, because when people see that Aster are able to go up so quickly, people are going to pay attention to the next perp DEX, lighter, HX, whatever. So the attention will, get siphoned away a little bit when, the whole wave happen. Then people will come back to the leader again. It's kind of happened in the central exchange space like 4 or 5 years ago. I'm not sure whether you guys recall, there's like an exchange called Fcoin. They were doing trade mining stuff.
I remember that.
Yeah, I know. The volume went crazy.
Transmine, yeah.
Exactly.
Yeah.
But then, those are... They didn't sustain. Yeah.
They were the first one of the incentive Ponzi-nomics.
Yes.
Actually, they were before the DeFi summer of all of the...
2019, I think.
Yeah,
18, 20,
I remember that.
Yeah.
I was aware. That was
true OGs, you see? True OGs.
That's right. We've been around for a while on this.
Yeah.
You mentioned, what are some other... we could talk about Pudgy. Are there other ones you like that are very, top of mind for you that people should be looking at?
I think those are the main one.
Yeah.
I mean, obviously, the layer 1 stuff are exciting. We're tackling $1 trillion of market cap in the next few years. But yeah, I think I would like to talk about Pudgy. I think it's the most exciting opportunity that's very non-conventional. You're not looking at it from like a DeFi finance angle. I think historically most of the brand.
So what are you buying here? You're buying a token or
buying a token?
Right,
Pengu.
you're buying the token.
Pengu token is the tokenization of the Pudgy Penguin brand. I mean, obviously you can own an NFT, but I think
now what does that represent? What do you get from that?
I think you get from I think the first target of Pengu is to overtake Dogecoin, because I think the thesis is 1.0 meme coin. The meme cannot evolve. Like it's getting a bit stale. So that's why you look at it. This cycle, Dogecoin have not done that well for the past 1 year, because there's nothing new meme you can talk about. But with Pudgy Penguin, you can always have new development with a very strong and driven team. Obviously, that creates a risk if the team did not execute well. Then it's not very strong. But if you get the best top class team to execute, continue to expand the brand, imagine that Pudgy Penguin in 10 years are like half as well known, as successful as Pokemon. You're looking at tens of billions of opportunity there. And I think this is something that's very slept on by the market, because it's just something, traditional finance investor can't really grab their head around.
So you have the NFT.
Yes.
And then you have the token.
Yes.
What does the token give you rights to?
I think you should look at it as like a brand currency. Yeah, it doesn't give you the cash flow or equity.
It's a meme.
It's a meme. It's a meme. But it's a meme that have the best team constantly promoting the brand, the awareness, and make people learn about Pudgy Penguin as a brand. And yeah,
what's the market cap of this one?
I think it's around like 1.5 billion right now.
Okay.
Yeah, it's like top 60, top 70 right now.
And I will say, technically, it's been one of the only multi-cycle crypto memes,
Yes,
right?
Correct.
I mean, outside of Doge.
Well, I wouldn't even call it a multi-cycle meme. It was an NFT. It was a brand. It was always a multi-cycle brand.
Yeah.
Yes.
I guess Bitcoin is the ultimate.
Yes.
Sure.
Look, so I'm not.
It's the only NFT that Tom Lee is rocking right now.
It's true.
That's right. This is custom GFP.
I'm not idealistic about it. Like, I mean, I'll say something controversial. I think Bitcoin itself is a meme, right?
Yeah,
it is a
Funny
brand.
is-
It is a brand.
Magic internet money.
What is a meme?
It has
A meme,
fundamental attributes.
meme
that
is a
allow
brand.
it to,
right? I mean, obviously, there's the whole
Yeah.
energy value behind Bitcoin. I get
Right.
that, right? But you know, it has the meme of
there is digital scarcity.
it's the first.
to contemplate.
Well, the digital scarcity is not the coin as much as it's the energy behind it. But,
Yep.
but yeah, I think you're right. I can embrace the meme value within digital assets. you know?
Yes. I mean, look at like Labubu, right? Pop Mart stocks.
Right.
Yeah, I mean, obviously that's
Those are the little
Yeah.
doll things.
Yes.
I met last night. The night before. I met a family office they were the seed check into that.
Oh wow.
Yeah, they were the seed check.
You might want to just put Labubus into the fund. I mean, I haven't seen the secondary. market.
I'd rather on the seed check to Labubu, but you can put Labubus into.
And you look at it, Pudgy Penguin is one of the very few brands that are able to bring the mainstream people in. It's one of the truly few mainstream product right now. Like, has one of the best, most balanced gender ratio community event I've seen in crypto as well.
Oh yeah,
So what you're saying is,
You gotta get everyone in, not just all the crypto bros.
that's right.
Yeah,
Alright.
you need a bigger,
Bigger tent.
Yes.
all right.
Yes.
Nothing on here could be said that could be worse than having our second to prior guest Arthur Hayes in his comments. So
Yes, definitely.
we're all PG relative to Arthur.
Not safe for work.
And from one Arthur to the next, I think this is a great Arthur too, and we're really happy to have you on.
Yep. Thanks, Mike.
Thank you so much for coming on to the Level Up podcast.
Yep.
Thanks, Arthur.
Simon.
Well, we're excited to be joined by David Schamis, CIO of Atlas Merchant Capital, but more relevant to our discussion, CEO of Hyperliquid Strategies. Well, welcome, David. How are you doing? I think everyone's probably dying to know how a PE fund manager got into becoming a Hyperliquid bull and a DAT CEO.
Yeah, so Atlas Merchant Capital, we're a private equity firm really focused on financial services. Banks, insurance companies, broker-dealers, brokers, the whole sort of gamut, capital intensive, non-capital intensive, all that. We've only ever done one other thing in crypto up till now, which was Circle, which, knock on wood, feels like a pretty good start. And, we were not crypto native people in that we're just going to buy a token because we think it's going to go up. That's not our business. But we do invest in things that look and feel like businesses, like financial services companies to us. We got to know Hyperliquid, I would say, in the spring in a serious professional way. We started looking at it very closely. It seemed to us like the idea of a DAT made perfect sense for Hyperliquid. I don't want to speak for everyone else. The idea of being the 101st Bitcoin DAT out there didn't seem like a great idea to me. It wasn't even on my list of things to do. But with Hyperliquid, first of all, at the time, there were no DATs. Now there's a couple others, but they're much smaller than what we did. And whatever all the advantages of the other DATs are, which there are, doing one with Hyperliquid in size adds another important thing, which is the scarcity value, right? It's not easy to buy Hyperliquid. It's specifically really not easy in the United States. And once I kind of figured that out, I realized, there is a need for another DAT in this world, specifically for Hyperliquid. And got serious about that, I would say, in the spring. We partnered with Paradigm. We were introduced to them by mutual friends because we had heard they're also looking at doing a Hyperliquid DAT. It took us about 3 days to go from meeting them to realizing we should partner together because there was no reason to have two competing large DATs. We started out late June, early July with a goal of raising $300 million in capital for this. By mid-July, when we announced, we were at close to $900 million. So, it's one of those things where we, as we started talking to people, we realized that it wasn't just me that thought this was a good idea, and we're able to raise a lot more capital than we expected. And that's how we got there. It's a long answer to your question, but hopefully that all sort of hangs together and makes sense. Today, I think there are two other Hyperliquid DATs. One is like 50 million of capital or so, and one is even smaller than that.
Yeah. Now, is this DAT live today? I know there's some interesting nuances around the transaction structure.
Good question. The answer is sort of. The company we're merging into is called Sonnet Biotherapeutics. Ticker is SONN. That is public. It trades today. Our deal hasn't closed yet. And the reason it hasn't closed yet is that unlike most other transactions, a large percentage of the money coming in, the capital coming into our deal was HYPE tokens. And because a large percentage of those people were U.S. taxpayers or taxpayers in general, we wanted to use a structure where that exchange would be tax-free. So you give us your HYPE tokens, we'll give you our shares. No one paid, the taxes are all deferred until you sell your shares one day. In order to achieve that, without boring everybody, you have to use a structure that requires a shareholder vote. So we've published 2 S4s, with the SEC, knock on wood, knowing a government shutdown might be upon us. I'm hoping we go effective pretty soon and we can get our shareholder vote and close the deal, kind of in the fourth quarter.
So is that because is the company you're merging into, is that not a large seasoned issuer? Is that?
I think that's one of the reasons. I don't think that's the only reason. I think to be really nerdy here, we're using what's known as a double dummy structure, which is a corporate finance and tax term. But the key to that is that it allows those HYPE contributors to take back our shares without paying tax. But the double dummy requires a shareholder vote.
So does the entity now, it already owns the HYPE, and once it merges in, okay, so
the entity,
you have not bought, have you raised cash as well for it?
Yeah, so about 64% are people contributing HYPE. The other 30-something%, is contributing cash. So the day we close, we'll have $500 some odd million of HYPE, and we'll have $300 some odd million of cash, and we'll use most of that cash to buy more HYPE, and we'll be off and running.
Fair to say maybe that's a catalyst for HYPE for people to have on their roadmap, the bulls.
You'd think so. On the other hand, it's not a big secret. We've told the world we're doing this. We have 2 S4s at like 500 pages that say we're doing this.
Right.
So, on one hand, markets usually can expect things like this and take that into account.
Not as a fit.
I was going to say crypto is different.
That is why we're in this.
Crypto's different. 2 weeks ago, HYPE was going up a lot because everyone was excited about USDH.
Yeah.
Which, is really interesting. I'm not sure it's so market moving that it should move the thing as much as it did. And then it went down a week later because all of a sudden everyone got worried about unlocks that I think have been well known for a long time. There's no new news, no new secrets. So you're right, crypto is less efficient than...
It's almost like we have competing open secrets here. DAT's lining up capital to buy and unlocks coming down the pipe. How do you think about that supply-demand balance?
I have a hard time predicting where the HYPE token is going to be the day we close, November, whatever, where exactly it's going to be. But we're pretty bullish long term. And again, I know in the crypto world, long term means something different than in the TradFi world. I think in both worlds, we're pretty bullish long term here. They want to be the home of all finance in the world, and it sounds crazy, but it doesn't sound crazy to me because I've been so close to this recently. There will be a time when we're all sitting here and we're talking about Hyperliquid being bigger than NASDAQ, and I really think that's true.
So David just talked with my boss, Tom Lee, who I think has done a phenomenal job at operating a digital asset treasury company.
It's funny you think that. Although he has. In all honesty, he has.
And something that he has been very effective at is communicating a thesis that traditional Wall Street investors can identify with. How much thought have you put into that marketing angle, and what is that elevator pitch for Wall Street? What does that look like?
I think the answer is a lot of thought. I think that we're probably starting even further behind than Tom did with Ethereum or all the people out there with Bitcoin. I mean, very few serious financial professionals, even ones that aren't crypto native, have never heard of Bitcoin. And probably very few also have never heard of Ethereum. But it is well known in the world. They might not be investors. They're certainly not experts, but they know of it. Very few people know about Hyperliquid. And I've spent a lot of time sitting down with a lot of people in the financial world right now. And I say to them, Hyperliquid's a company you probably never heard of. It's been around for less than 3 years. It has 11 employees. It's never taken a nickel of outside money. And its run rate free cash flow right now is about $1.5 billion. And there's all sorts of good reasons why this is just the start, this is not where they're getting to. This is like the scratching the surface on where they're headed. And you sort of take people through that and they understand. They say, okay, fine, I get it. How do I buy it? And then it's well, that's a more complicated question. You can't just open a Coinbase account and buy HYPE. Particularly if you're in the United States. You can't do that anywhere.
Right.
You particularly can't do that if you live in the United States. And that's the point I made earlier, why I think, the reason for being for this DAT, for our DAT, just makes a ton of sense. And the day may come in the future where it's easier and more accessible to U.S. people or to any people, particularly U.S. people, to own Hype. But I think there's a lot of room between now and then. That's not happening tomorrow.
It reminds me of, I used to be head of research at Grayscale for a time. And for a long time, GBTC was just the only access vehicle for a lot of people to really get access to even Bitcoin.
Sure.
And maybe you're that for Hype. Beyond, the access in the value proposition there, in your DAT structure, how are you thinking about NAV growth? And then, maybe also longer term, how are you thinking about maybe participation in the ecosystem?
Yeah, 2 points. Day one, when we close, we're going to have a fair amount of Hype. We are going to stake it. We're going to earn our yield. So we have a little bit of sort of, book value per share growth. That way, we also plan on looking to raise capital in whatever structure makes the most sense to get as much of that book value accretion as possible. So that's sort of the day one plan. I think the day 2 to day 360 plan, the 365 plan, is doing exactly what you said, figuring out ways to be in that ecosystem where we could effectively earn more than the staking yield without taking materially more risk than staking risk. That's sort of how I think about it. And I think, there are like 19 validators on the Hyperliquid system right now. It's not like there's not that many. It's still, relative to Bitcoin and ETH, like it's still growing. It's still very young. And we think there'll be a lot of ways to be in that ecosystem, which really is moving. To be a HIP-3 contributor, I think it used to be 1 million Hype. Now I think it's 500,000 Hype. That's a lot. We're going to have 18 million doing nothing for a while. That's pretty valuable to a lot of people. Maybe
final question. What are some of the quick risks and catalysts for both Hype and then your stock?
Oh, I mean, risks, we've certainly learned about risks around Hype in the last couple of weeks, which is, a little known guy named CZ woke up and decided that.
I was thinking about it.
Yeah, maybe can we double click on that?
Right?
A little known guy named CZ woke up and said, this DEX thing is pretty interesting. And, people suggesting that Hyperliquid's going to eat Binance's lunch, better think twice. So that's clearly happened in the last couple of weeks. That's another thing that's put pressure, I think, on the Hype token.
And how are you thinking about that? Because that's a pretty present thought on, I think, a lot of investors' minds right now, just from a competitive landscape perspective.
Well, it's like Solana versus Ethereum, right? And Ethereum's still here, and we just had Tom on stage, and BitMine's doing great.
Yeah, look, I think on one hand, imitation's the highest form of compliment, or whatever the expression is. And he is, probably the highest form of market operator in the crypto world. So the fact that he is telling the world how important this is and how relevant it's become doesn't sound so terrible to me.
Right.
The other thing, like competition, is always a good thing. Like it makes everyone operate better and stronger and all that. On the other hand, the positive part, or whatever, the more competitive part from my point of view, Hyperliquid wasn't built in a day. It's been 3 years, but it hasn't been 3 days. And there's a very, very loyal community around it. And, part of that loyalty is they didn't take any third-party money. There are no VCs getting rich here. The airdrop that they did, 10 or 11 months ago, put a lot of money in the pockets of put a lot of tokens, as I say, in the pockets of the big contributors to the system. And I think that, the future, the huge success of Hyperliquid is not if, the number of people trading perps on it today doubles, in 6 months from now. Like the huge success is whether it's HIP-3 or builder codes or other people figure out ways to access the liquidity and add to that fee stream without it necessarily being known as Hyperliquid, right? Like right now, you can pull out your Phantom wallet, you can trade perps. You have no idea the back end is Hyperliquid. Maybe if you dig through the prompts, whatever, you might be able to figure it out, but you don't really care. That's not the thing. And I don't think Jeff at Hyperliquid wants like that brand, that name to be bigger than Binance one day, even though it might be as important as Binance in the ecosystem and in the crypto world.
All right. Well, with that, thank you very much.
Thanks, David.
Thank you, guys. Nice to be here.
That's a wrap for this episode of Level Up, where liquid token protocols meet the sharpest minds in institutional investing.
If you found value in today's conversation, don't forget to subscribe and share it with your network.
For more deep dives into blockchain's most compelling projects, reach out to us or follow the Medici network for more insights. Until next time, keep leveling up.